Very good morning to my dear friends, colleagues.
Good morning, ma'am.
It was told to me that you need to speak on the service industry. And I was wondering which service industry should I pick up? It's so vast. The latest tax amendments, when you're talking about what is the shift, Mr. Nehar just a little while ago talked about the technology. The technology which has changed the world precisely, the pandemic which we saw was just a catalyst to what we experienced earlier. There was technology all the while, it came up gradually, but when you were left with nothing else, it was plunged into by one and all. So, what we could see, it was a tectonic shift in business. And not just business, we saw even the tax department. And nothing stopped, nothing was paused for a moment. So, looking at all this, thought as to which is this sector, you see the e-platforms, the e-commerce industry. I thought I will touch upon that, the relevant one, because everything now seems to be moving towards it. The earlier past, when we were talking about brick and mortar, is now a click show. You have everything and everybody wants to. However, sooner or later, there was a lot of resistance coming from the Baniya community. Otherwise, thinking no, people will not want to shift. But things have changed. People have learned to adapt to this kind of change. The earlier laws which we had in place were not sufficient to harness this kind of movement in the tax. The things had to be trailed. How do you capture? How do you capture what is moving around, which without being felt, without being seen? When you're talking about platforms, look at the e-commerce platform like Amazon, Flipkart, where goods are sold. You're talking about transportation. You see Ola, Uber, apps. What are they doing? It's a platform. It's a platform where you have the seller and the buyer, you have the provider and the user. So they're just communicating this kind of a experience, which, and you need to capture this. The government was not lagging behind. They were on their toes to watch this movement, and they had to realize how best to capture this. Similarly, you take the example of booking online. You're talking about Make My Trip, all such sites wherein you wanted to search, they were ready with providing answers. Not one, many. There were sites to provide you the best possible lower ones. So it's a kind of shift in the way business is being carried out today. Ordering food, sitting at home, nobody wants to move. You can just take up Swiggy. Today, here, as we witness, people want to look at the reins and think whether they'll be late in attending. Yes, you have the chance of going virtual and you take up that. So it's certainly the element of personal is missed, but the other side of it, if you view, rather than escaping everything, there's certainly something you can make use of. The government realize the vast potential in this e-commerce industry. When we're talking about this leg of it, it's not just India alone we are concerned about, it's the world we are looking at. What were we talking about earlier? We were talking about permanent establishment, large MNEs looking at how business is to be done. They were established in certain countries, jurisdictions with low tax. The international tax community could feel this, that there's a base erosion, there's a profit shifting which is happening. We have witnessed the pillar one, pillar two. We're talking about that. It started all with the BEPS 1.0 program. It was under that program that 15 actions and final reports of 15 actions were delivered by 5th of October 2015. The multilateral instruments for the modification of these treaties was negotiated in 2016 and many countries by 2017. Various changes to domestic laws were made. Section 286 was introduced under the Income Tax Act. We are talking about the CBCR and the master file reporting. All these changes did not have any impact on the cash flow. They were reporting requirements. There was no P&L impact. There was no cash flow impact. Reason, and they were hitting certain MNEs which are large group based. Moving further, the next step, this was structured in a manner that you could cross the first and then come to the second. You're talking about BEPS 2 now, 2.0. Under the existing laws, many different countries impose different corporate rates of tax. The large multinationals have structured themselves in such manner that they lay in a jurisdiction with no little tax, and the ultimate entities were not getting the required tax. Also, it was experienced that market jurisdictions lied somewhere else. You're talking about reporting profits or no profits in some jurisdiction, whereas you're earning profits in various other jurisdictions. In order to get to this problem of the leakage which was witnessed by the international community, we've introduced this BEPS 2.0. In BEPS 2.0, we have the Pillar 1 and the Pillar 2. Now, what is this Pillar 1 and Pillar 2? Pillar 1, when we are talking about, largely talks about entities like Amazon, Flipkart, where the goods are being sold in across various jurisdictions. However, the reporting happens only at a very different jurisdiction. Everybody misses on that pie of their share of tax on this. Going forward, it's quite a complex task. You should appreciate this, because when you're trying to tax market jurisdiction, how do you know which product is ultimately consumed where? This is a large gaping hole. It had to be, there was a lot of debates as to what needs to be done to capture this. How do you capture where the ultimate consumption is idly happening? So there's one leg of it, one leg of rules which cater to this nexus theory, to see how you will get to where the market is. There is another set of rules to see what is the profit element you're trying to allocate to these jurisdictions. So therefore, these two set of rules, accompanied with the formulatory approach which they're going to have, is a very complex structure. Thankfully, this applies to very large entities. We're talking about the strength here of some 700. The threshold here in this case is much higher than the one under Pillar 2. Pillar 1 talks about 220 billion euros, approximately 1,60,000 crore of rupees we're talking about. So this touches those kind of entities which have such a wide spread across the globe. So what is going to happen if an entity is reporting, a constitute entity is reporting a profit which is lesser, the ultimate parent reporting an turnover of 1,60,000 crores we're talking about, reports a profit of more than 10%, then the surplus of that profit will be allocated to these jurisdictions, the market jurisdictions. Now, that's how the challenge is. Which are the market jurisdictions? The entities which sell software across the globe, there'll be many other companies where the ultimate product lies in a very different jurisdiction. So this nexus has to be drawn, and the surplus has to be distributed. Work on this pillar is still in a work in progress, and much needs to be done on this. India is pushing for this. We do not know what we'll stand to gain. There are theories, because you're talking about distributing only the 25% of the surplus of 10%, which appears to be a minuscule when it comes to India as a market. Whoever is going to, Amazon, if they're going to give us, and how do you think they'll going to report those profits? And the surplus over 10%, and of which 25%, how much is allocable to India? This is what we are seeing in exchange of what we will give up. Or what are we giving up? Today, unilaterally, the certain countries, jurisdictions have imposed taxes like the equalization levy in India. We are viewing the 6% which we are collecting vis-a-vis what you're going to trade off. So whether it is really, though we're pushing for the Pillar 1, I do not know how much of it will really effectively come in days to come. Earlier, the intent was to bring both the pillars together. What we've seen is Pillar 2 work is being pushed at a much faster pace. 138 countries of the G20 and have come together, and they have given a sanction to this that they will be implementing it. Now, what do you have in Pillar 2? In Pillar 2, you have something called the globe rules, and you have something called the STTR. That is another pillar by itself. What is this STTR? We are talking about intra-group transactions. If they are going to be charged in a jurisdiction which is lesser than 9%, then there is some rate which is going to be imposed to capture this deficit. So these are the STTR rules, which will again go by the MLIs, and treaties will have to be modified. Work is on this particular leg of this paper, which the STTR. However, when we're coming to the globe rules, now again, there's complexity in the Pillar 2 globe rules. What is intended here is a minimum rate of tax across the globe. People have shifted their businesses to low tax jurisdictions, and other jurisdictions have lost that share. They look less competitive to businesses vis-a-vis places where there is a lower rate of tax. It's decided that such MNEs, when they are ultimately looked upon, they will, if some country does not recover the 15%, the ultimate parent will have the right to recover that deficit. If it's taxed there at a 5%, the deficit here between the 5 and 15 will be taxed at the ultimate parent company. When you're talking about ultimate parent company, what if this country does not really go in for the Pillar 2? This right is lost by this country to collect. So where does it go? It goes to the next level. So that is a UTPR, the next level. So the next country which has a link in this will have the right to collect if it has also joined the Pillar 2. It's implemented in that country. So this is how it is going to flow. So we will be at a loss if we do not impose this sooner or later. So countries are looking forward to see this, that they will ultimately get into this, and because this is what was initiated by all of us. We really could see countries like the Middle East where there was low nil rate of tax, and businesses there, at least the registered offices are there, they were reporting profits, whatever they were doing there, and we were losing a pie of that. So in order to come, now when you're talking about to introduce Pillar 2, apparently they will hit entities with a 750 million euro turnover. It's approximately around 6,700 crore of turnover. Many will get covered under this. When you're talking about looking at these entities, the requirement of doing a Pillar 2 exercise requires you to touch upon some 180 to 200 data points. That's the cost at which technology comes. So you are going to revamp your systems. It's humongous. It cannot be done on its own on a manual base. So therefore, you'll have to take a shift to let these run into your systems eventually when there's certainty in how it is going to be imposed. So I think primarily it may be a very rough exercise to begin with, though there are entities which are multinational, they've already started to impose this, carry out changes, modifications to understand the implications, because sooner or later you're going to have this. So this is the kind, when we're talking about e-commerce businesses, there are challenges for them. The cost aspect as to not just running the business, also what tax imposes upon them. There's a tax cost, and to implement the tax cost is another cost. So this is not certainly a very, and after bearing all this, they still have to face assessments, and your jurisdiction like ours, that's how we feel that there has to be some kind of objectivity to the entire assessment procedure. We have entered a system wherein we can see the system is now helping much of the work. But however, when you're leaving assessments appeals to the faceless, there's a human element. And how much of that can be changed? I think eventually it has to move to a time where there'll be no human element. It'll be just they reading your data directly. So the department will have an access to your systems. They'll have a structured account wherein they will be able to derive what they wish to. Today, you file returns with GST. You are asked to do that again in your tax audit. So it's multiplicity. It increases your compliance costs. Government they give you a long questionnaire. You are supposed to compile and give them the ready material for them to assess. And you go to explain. It's a very difficult task. You may be convinced about your reconciliations only at a very higher forum. Somebody really looks into. So it's a guiding thing that, to tread on the line of caution. What if I'm not right? Perhaps that's the theory there follows there, and additions are made so that, you get it in appeal. That's normally what you hear in assessments. You get it in appeal if you're right. So a little bit doubt here and there. This is how it flows. Recently, there was on, I think, 12th of July, there's an update on the BEPS. If I can just take you through that. The two-pillar solution to address the tax challenge from digitalization of the economy will ensure a fairer distribution of profits and taxing rights among countries and jurisdictions with respect to the world's largest MNEs. On 12th July 23, 138 members of the OECD G20 Inclusive Framework on BEPS, representing over 90% of the global GDP, agreed on an outcome statement. Now, what is this outcome statement? They have said that this may be delivered to the G20 finance ministers and the central bank governors who are meeting in Gandhinagar this 17th and 18th of July. So if this sails through, in parallel, there's technical work continuing so that the MLCs can be opened for signature, the multilateral conventions can be opened for signatures, because there needs to be a treaty shift. We're talking about treaty, now we are going to amend those vis-a-vis countries. Further work on amount B of Pillar 1. We were talking about Pillar 1, which is not sailed through very much, but there are two amounts. That we talked about amount A, there's an amount B as well in Pillar 1. So the work on Pillar 1 to be launched next week is a public consultation. So they're beginning work on the Pillar 1 B amount. So amount A is some frame they have got, now it's amount B. And it is slated for completion by this year end. The agreed documentation relating to the STTR, that is the intra-group taxation amendments, which they're getting again through the MLC, through the treaty, that is going to get published next week with MLIs to be released and open for signature from October 23. So we can hopefully see that as taking some shape. OECD will also prepare a comprehensive action plan to support the swift coordinated implementation. Apart from the global measures, what is happening on the domestic front? These were some of the changes, because you're talking about e-commerce, you're talking about e-markets.
I'm attending the IB.
Therefore,
I want to distribute my business card for partners. All this.
the domestic introduction of certain sections which had to take care of the shift which we're talking about in conducting business, section 194O. What is 194O talking about? According to 194, an e-commerce operator is required to deduct tax for facilitating any sale of goods or providing services through an e-commerce participant. So there is a participant and there's an e-commerce operator. Earlier, what was seen is that during the pandemic, we saw most of the people getting onto platforms, selling their wares, and people going to platform, buying them. But all this was just getting uncontrolled. The people may not be filing their returns. The government could see this is for widening of the base. This introduced a 194O. So though they have introduced this, there are quite many challenges. Now, what happens when there is a market, e-commerce market, and there are various products which are being sold on e-commerce market. So this e-commerce market is viewed as an e-commerce operator. On this, if you're selling, say, for example, insurance, then you also have an app of the insurance aggregator launched onto this e-commerce platform. So are you talking about both being subject to 194O, and 194O talks about the gross? So what is the amount on which TDS is going to be withheld? Is it really conducive to business? And there's no clarity. So when you're talking about all this, what we expect least is that as soon as there are certain kind of, I think the government has been quite supportive and they have time and again come up with circulars and notifications, but at times the circulars and notifications come just in a very short while and addressing only a few of those issues. And repeatedly, again, you have clarificatory circulars. This is what has been seen as a trend of late. That, very soon you have one circular, you have something else overriding that to explain that further, clarify. It ultimately results into a mess. I think a lot of work should go before you actually draft a law. The drafting has to be with consensus from the industry, and industry also has to take upon itself the onus of going and explaining as to how this will be hitting them. It's become something which comes post. It has to come pre. So instead of blaming, I think somewhere we should understand and also become proactive and taking forward our matters. If they're talking about some kind, then of course you need to have listening ears there to understand the problem and getting to the object. So you do want to tax, you thought of widening the trail for 194.0, but you're leaving many such unanswered questions. Look at GST on the e-commerce. On 11th July 23, they were expected to clarify the TCS liability on suppliers engaged in e-commerce trading through the ONDC. In cases where multiple operators were involved in a transaction, there is no clarity who should be liable for the TCS under the GST laws. The GST Council in its 50th meeting has said a circular would be issued to provide clarification regarding TCS liability where there are multiple e-commerce operators who are involved in a single transaction of supply of goods. Similarly, the income tax also should rise, and as in how they're posted, there should be some forum to address such nuances of new laws. When they come to it, its implementation, nobody can foresee all what is going to come. There'll be different situations, but there's certainly we need some guidance and to look at the litigation where it boils down. It takes years for anything to get settled. So you keep on following it year on year. The department keeps on assessing you on the same year on year. This opens up years later. There are reopenings at times. If they miss something, you see faceless. You got assessment orders, but very soon you got 263s. You got reopening. You were a host of 148s. They went to the High Court. They went to the Supreme Court. Supreme Court, you had a rerun again. I mean, it is just too much of it. Of course, CAs will not be out of business, but it's at a very high cost for businesses. So that's how it has to be viewed. Looking at 194R, R was introduced. The purpose was to plug the possibility of tax revenue leakages in business and profession. As consultants, the very basic example, any consultant you engage will travel for you. He'll go somewhere, he'll incur some hotel, some food, something for himself. When you're going to reimburse, 194R doesn't look whether it's in his income. It doesn't even look whether that amount is actually in nature of income. It says withhold. It simply says withhold tax. So these are the vagaries of law where we experience that it gets a little too much. What you intended to start with was to tax perks and benefits. We're coming even to something like a reimbursement, pure reimbursement. You look at directors. I'm talking about companies who will have directors coming over for board meetings. If you tell them that you've got an airfare ticket, we will not give you all. We'll give some portion of it in a form of TDS. You show it in your return. You take a deduction of it, and then you claim this. I mean, this is getting a bit too much. So several aspects, and certainly people will understand, but the business community, it will be hard to digest. The whole call is when profits are being offered, we are coming and offering our incomes, then why this? So you have to then go forward and tell them that no, this will be, you book it in our name, so you can avoid this. So getting into all those, so we are being trained. Ideally, what I see as, if you look back, step back and see, earlier it was, at your assessment level, you faced assessments, etc. Today, the way it is moving, you file e-returns, they process it immediately. It will get to a system where the assessments will happen, and you are ultimately creating kind of allowing people to comply on their own. People are coming, you're training them. So instead of having a whole workforce at the IT Aikar Bhavan, you have everybody who understands what they're doing. So this is kind of creating a tax sense in people as to how it will flow eventually. So they should have tax as a subject right from the beginning. So, this will obviate much of the unnecessary, because the word tax itself sounds very taxing. It sounds very heavy. So it has to be something which has to be understood by people. Everybody is here to earn. And believe me, nobody even can file their salary returns. I mean, it comes to that. Even we have challenges looking at the systems. Of course, the younger generation, so tech savvy, will be able to see that, but unless they understand the nuances of this. So this is one thing. Then you have the virtual digital assets. We were talking all this while about platforms where physical goods were bought and sold. Now we're talking about virtual assets. So you're talking about assets which again translate into a digital form, and those were being traded. So not on a very far foot, the department immediately caught upon them. So you had something like the 184S, which was introduced to capture this aspect as well, that you are going to tax the virtual digital assets. We're talking about 2061G, which is a recent, there was an amendment on the LRS. You're talking about what happens, the section primarily applied to liberal remittance scheme. It expanded to even take up tour packages, which hits, I think, virtually everybody. So therefore, this is kind of expansion of scopes. So something liberally remitted, okay, you're taking a foreign travel, even that's kind of a remittance you're making, whether or not you're buying it here or buying it there. So this kind of clarity, now you're in this budget, you're seeing that it was going even to the credit cards. There was a lot of hue and cry. The representations did prove some relief. So all of the change in rates now to travel, one will not have to incur 100, you will have to incur 120 from October onwards. Today it's 105. Now you'll have to incur 120. Then you go and remap your advance tax. You go and remap your TDS. We are giving you credit. So if you're giving me credit, 20 is a big sum. Anybody taking a foreign travel will have to forego that amount today. It's a tax-paid income which you're spending on your foreign travel. It comes to you if you're salaried employed, it comes to you post your TDS. So this is going to pinch the common man. And 20% is way too high a rate. You're talking about shrinking the world, coming together, and travel is, I think, taken for. Today, everybody does travel abroad. So this is kind of, most of them will undertake this travel some or the other point in time in life. So therefore, this kind of, negativity to that should not be associated, especially the increase in rate. If the only intent was to check the transaction, then 5% was a good rate. You could have stopped there. It has now got to go higher. And further to that, the banking systems have been asked to pep up to now even monitor the expenses one incurs on a credit card outside of the country. You're talking about a threshold of 7 lakhs. They'll have to map all that. The onus of collecting, collating is all coming up to the providers, the service providers. It's shifting from there to here. And now we just read in the papers, the SFTs are also being called to see what kind of data they are furnishing. So it's not simply a compliance that you're making. You'll be held responsible for what you're making. Of course, that is important. That is the only manner in which, you can get the right data. Otherwise, they'll report something. It's a challenge for you to look every time at your AS, reconcile, and tell it's not this, it's this. So entire department work is now being done by us. Slowly, they've been pushed to that burden. You see in a house when the daughter-in-laws come in, the role of the mother-in-law is gradually easing out. So this is what is happening when I see in a lighter vein. So coming to the next kind of sector which has this impact, I think, is the digital financial services. You're talking about what is that transition. Business cannot be seen without finance. So certainly that's a very essential element. And look at what has really pushed the kind of business. Talking about guys, you're talking about digital payments. All this is a step higher. That is how businesses got into where it is today. With e-commerce, if you're talking, without this kind of offerings from the digital world of finance, would not have been possible. How would you remit? How would you close a transaction? So this is another very essential part of it. The government has seen this very well, and they have come up with the gift city. Seen that, what is that push that, what is that they are giving you? They're giving you kind of a hub, an international standard hub where businesses can be transacted. We had a section of 194 LC where you had foreign currency borrowings. There was TDS, which was pushed year on year that, okay, you have a TDS at 5%. Reason being that most of these borrowings came as a cost to the borrower. So 5% was a concessional rate and people were availing that. This June, that 5% has been stopped. So if you're talking about treaty rates, it's a 10-15%, the business cost goes up. Alternate to this, if you see in the gift city, when these banks, then you borrow foreign currency loans through these, there is no tax, there is no withholding. So this is kind of an indirect move, a push to step up the gift city. So people have to move towards that. We're talking about hubs, the airlines hub, the industry hubs. Their leasing is a big time activity, which is getting again pushed to this kind of gift city. What does it offer? The gift city gives you a 10-year holiday period. There are no book profits, no MAT profits if the tax is paid under the new regime. Else, there is a reduced MAT of 10.48%. No withholding on interest payments from Gift City. The enhanced cost, which as I explained for 194 LC, can be mitigated if borrowings are made through the Gift City. There's a nil withholding on its income subject to a declaration form. So anybody in India, if you are going to give something, some payment to the Gift City, if you fill up a form and take the certificate, then you don't need to withhold tax on their income. So the entities which are placed in the Gift City will be not suffering a TDS. The stamp duty exemptions, the corporate law relaxations, there are other incentives like electricity reimbursements. So these are kind of push that IFC unit at Gift City is under a non-resident, it's treated as a non-resident under the extant FEMA regulations. So this is how it is viewed. You are also in India but out of India. There's another section talking about is the angel taxation. What is angel taxation? Any new startup had to increase the funding at that stage is required. So had their equity to give out with a commitment that as and how it progresses in business, you can encash out of that. It was seen that the price at which the shares were put out were something way beyond. So you had the option of taking a net asset value valuation, you had a DCF, you take higher of the two, and money was being bought in under that route. So earlier 56, which you're talking about 27B, which was introduced only for the residents. Only when you had resident shareholders who would come and give this amount, if there was anything exceeding this value, was taxed as income from other sources. With this budget, we see this extending to the non-residents. They are governed by many other factors. They were kept out for some reason. You brought them in again. You have now tried to see as to you can even take up this difference. There are certain laws which RBI requires. You can't bring it below that fair value. You're talking about here, you can get it more than the fair value. But what is that value? So, also another typical thing is different laws have defined different concepts. When I was talking about e-commerce platform, I was talking about insurance regulators sitting on the e-commerce platform. The way they define and the way the income tax defines, they're at par, so at a variance. So therefore, sorry, not at par, they're at a variance. So this is the reason that it leads to further complexities. You need to clarify, because that you complied with something under income tax should not fall foul under some other law. So the intent has to be taken care as to how this is, simply because the term used is the same, cannot be carrying on the same meaning. Then there is a new, but thankfully again with representations, we could help this provision also in diluting the kind of rigors it came up with. We have now extended to where these upon representations, the clarification which is got is foreign investors are allowed to take value of shares using valuation methodologies which are yet to be notified. So there is some different set of valuations which we will foresee and they're yet to be notified. A new concept of safe harbor provisions permits subscription of shares within a range of 10% of the fair value. So this is a further concession which has come. So plus and there's a safe harbor of 10% which is provided for such inflow. So friends, I think with this, I take a pause and I want to understand if I was able to explain and express myself about the new laws, which have the new sections which are introduced to change over from the traditional form of business to the entire shift in what we saw in not just in the business, also therefore in tax and now the tax technology. So I hope I have sufficiently addressed. We are in store for looking at something like a chat GPT. Sir was talking about that you have access. Earlier you had little volumes to read through, you had to analyze, take out at the tip of your finger. Today you can analyze something. With chat GPT you go a step further, you just give the problem, it gives a solution as well. But it is not kind of, you still need to apply here whether what it's saying. With a human brain, you'll never satisfy yourself that this is all that you want. So therefore, how much ever technology progresses, I think there is some way that we can add value, and we should be therefore looking positively to do this technology. It will ease your compliance burden, free you from doing the routine, the unrun, and concentrate more on analytics and understand how you can further add value to wherever you are. Thank you. Thank you, my dear friend.
Friends, any questions or anything you want to discuss or anything?
Yeah, anything, any informal discussion you can have. Today we are a close set of people.
My question.
Yeah.
Hi, I'm Harsh. I just wanted to know your views on the latest GST that the government has levied on online gaming and betting. So, would that be a killer blow for the industry, as most people are saying, or would the industry adapt and work around solutions?
So, this is kind of what we read yesterday was more driven out of societal values
Yes.
when you're talking about this. So ask anybody about gaming. Clear view will be it is not a business, it's not a trade. I understand the employment factor, the other factors. This is how old in the system?
Gaming,
Online gaming.
is a recent phenomenon.
Right. So I'm saying it's not as though you're accustomed to this kind of, suddenly people are going out of jobs. Not happening. It was only a recent origin. You're killing jobs, but certainly there'll be space enough. I believe 28%, you cannot look at it differently from horse racing or from any other kind of gambling. Online gaming is also a form of gambling. They've clarified it's with stakes or without stakes.
Like a wager.
Yeah, right. So when you're talking about with monies, when you're doing it, it's a fair ask, I think. My view, my personal view.
But I think going forward, a lot of companies may move abroad because I think if you
tax and GST.
Yeah. have tax, GST,
Even the income tax will pull up.
It's killing. It's certainly killing that industry as I can see it. But then whether we want it or not, you can't be seeming to encourage this form of
Yes.
gaming and not the others. Then the others will rise to the call. That's all.
Thank you so much.
Thank
Anybody
you.
else?
I think.
I think we all, no, it was really nice. I think at least I've learned so much from the extensive the coverage which Madam has done, right from from BAPS to the various assets, and I think her extensive experience in not only in practice but also industry says so. On behalf of all the members present here and on behalf of the CA Institute, I would like to propose a very well-deserved vote of thanks to
Thank you
ma'am
so much.
and for sparing your valuable time on a Saturday
Thanks.
morning. And I'm sure in times to come in future as well, we will be